the Fed is going to have to print a lot more dollars to reflate everything. Everything will be reflated, including Bitcoin, except the only difference is that the thing that's going to go the highest, the fastest, going to climb the fastest is going to be gold and silver. And everything is going to become a lot cheaper in terms of real money as the value of credit falls and falls.
Look on the similar chart of where we are, you can see if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher. I think that's kind of where we are. We're right in this cusp of just the last month or two where I think gold and the precious metal space have one more big run. And the big question is, does the stock market stall out and the money coming out of equities, does that get pushed into precious metals to create this giant rally? So that's what we're just kind of waiting to see.
In 2007, everything looked fine. Stocks were setting new records, optimism was high, and few people saw the cracks forming beneath the surface. But while equities climbed, gold was quietly gaining strength in the background. Then came the turn. Stocks rolled over, gold dipped briefly, and within months it exploded 30% higher as money rushed out of equities and into precious metals. Chris Vermeulen, chief market strategist at thetechnicaltraders.com, says we're seeing the same setup today. Gold has already had a strong run and got crowded as traders piled in, but this recent pullback isn't a breakdown, it's a reset. He believes the next major move is still ahead, and that this consolidation is just the market catching its breath before gold takes off again. It's not just gold showing life. Silver, platinum, and gold miners have all seen new inflows, hinting that capital is rotating toward the metals space. Technically, gold has pulled back to a key support level, its 50-day moving average, which often marks the point where uptrends resume. With sentiment cooling off, Vermeulen sees that as fuel for the next leg higher. His target, $5,100 to $5,200 once this phase ends, with silver likely to follow a similar path upward. Miners may lag for now, dragged down by overall weakness in equities, but the metals themselves are holding their ground. In Vermeulen's view, this pattern looks almost identical to the calm before gold's 2007 surge, and if history rhymes, another powerful rally may be closer than most think. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Yeah, so this is 2007 stock market top. The yellow line is gold. Is this the one you're talking about?
Yeah, let's do that.
Okay, yeah. So what I find interesting here, and you and I have touched on this, is the stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is if we look on the left chart, I've layered in multiple different assets down below. So we have GDX, which is gold miners. We got silver, platinum, and palladium. And this is what I've been talking about for the last little while is everyone's been piling into gold. It became a short-term crowded play, which is why we've got this initial little pullback. But you can see that in this chart. When we look at what people have been doing with gold miners, with silver, with platinum, and palladium, money's been moving into this space. So whoever's open to the concept of holding physical metals, they have been piling in. It's been a little bit of a feeding frenzy. Things got a little overbought. When we look at what happens after this, we tend to see the yellow line, gold, shoot dramatically higher, rallies about 30%. The stock market ends up struggling. So I think money pulls out of stocks. Money's always looking for a return. So it's going to move to whatever's got momentum, which is gold. It's also going to be miners. It's going to be silver, platinum, and palladium. So that's kind of where I think we are right now. If we look on the similar chart of where we are, you can see if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher. I think that's kind of where we are. We're right in this cusp of just the last month or two where I think gold and the precious metal space have one more big run. And the big question is, does the stock market stall out and the money coming out of equities, does that get pushed into precious metals to create this giant rally? So that's what we're just kind of waiting to see. Based on a pure momentum play, this is telling us based on the momentum of it in the pullback. Usually when you have the first pullback to a key moving average, like if I just go back to the daily chart, when you have a very strong run and rally, one that just shoots up and then you have an emotional kind of blow off phase, when it first drops back to a key moving average like the 50-day, generally it wants to have a bounce and it's going to want to go higher. This is just, even though it has pulled back and reversed to the downside temporarily, overall, this is just the first pullback within, I think, this major trend. So it's not so much a long-term investment. This is like an active trade. We're looking for it to run up to about 5,100. And again, what it's done is it's pulled back into a support zone, and sentiment is favorable for it to go higher because people don't want it right now. So it's just that support. It's oversold, and the underlying long-term trend remains up. Yeah, silver's doing much of the same thing. It's consolidating, a little more volatile. It is trying to carve out a bottom as well. We've got this potential little bit of an inverse head and shoulders. It's trying to build a potential rounding formation here for it to break and pop to the upside. It's nice to see actually silver holding up the way that it is. Sometimes you see it really have some big red bars to the downside. But again, I think they're going to move more or less in sync together. I think the metals are holding up better. They're not making lower lows at this point. They're not breaking the lows from about a week ago. And that's, I think, because they're not connected to the stock market. The stock market is pulling back. Gold miners are stuck in the stock market. And as you and I have talked about, I look at the markets like the ocean tide. When the tide goes down, all boats go down. So if the stock market tide is going down right now, and you got a gold miner that's stuck in that tide, it's naturally going to have more pull to the downside. Whereas gold and silver are a commodity, they're not even connected to the stock market. And so they're holding up better because they don't have that falling tide with the mass psychology of everyone kind of dumping stocks and selling. So I think gold miners are telling us what the sentiment is. People are panicking, they're selling and moving out. And I think it's telling us, and gold and silver are holding up. So I think it's an emotional pivot low, and I think we're going to see the market carve a bottom out if it's not already in for gold and silver here. Precious metals and miners kind of have this weird relationship to each other at times, and they also can decouple from how they move with the stock market. Sometimes they move with, sometimes they do the opposite. That's what creates a big wild card when it comes to trading the precious metals space. You just don't know if it's going to move with or against the market or the opposite direction. I think gold miners, like we got into this whole kind of little bit of a feeding frenzy phase, same within gold and silver. A lot of people moved in right up into this phase. And so now when you have emotional money moving into the market, when it does reverse, you have emotional money moving out, meaning you usually see everybody pile in at the same time, and then they all kind of bail out and sell off. And I think there's a lot of fear in this market. And I think that fear is causing a trickle effect of money flowing out. And gold kind of shows it in a little bit more of a kind of a relaxed way. It's not moving quite as dramatic as the miners, but overall, it's just an unwinding of events. So, for example, gold had hit our measured move right over here. We ended up playing this really nice trade to the upside on this breakout, and then after that, it went into this kind of bubble feeding frenzy mode. And everybody who got out with me on this target, because it was a pure technical trade, that was our target: get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater. And now I actually like gold here. And everybody's like, why do we want to get into gold? It's reversed, it's selling off. And so these are these important like turning points. When everybody wants it, you don't really want it. And when nobody wants it, especially when it's in a super bull market like gold right now, that's usually marking a low. So I think gold is trying to find a bottom here. I think we're going to see that happen fairly soon because everybody seems to be bailing on their gold miners. As you said, they're moving out, they're selling off, and they're kind of giving up on it. And I think I think we'll see a bottom potentially this week in the precious metal space. And miners are down the most because they're kind of this very liquid. They're not very liquid in terms of they sell off. They're a small market, and when people sell them, they drop quickly.
Rafi Farber from the Endgame Investors says the Fed's standing repo facility, now at record levels, isn't some new innovation. It's just another way of pushing dollars into the system. Changing the label doesn't change what it is: money creation to keep the financial machinery running. But beneath the surface, Farber points to deeper structural cracks. The weakest links are showing in areas most exposed to higher rates, especially commercial mortgage-backed securities. Office real estate has been hit hardest. Remote work has permanently cut demand for office space, and the data backs it up. As of October 2025, delinquencies on these securities climbed to 7.46%, the highest in years. Office loans hit an alarming 11.76%, while even multifamily properties, usually stable, rose above 7% delinquency for the first time since 2015. Farber believes these are signs of stress that the Fed can't ignore for long. When the pressure builds, he expects another wave of money printing to save the system, just like in 2020. That would inflate asset prices again, but unlike speculative assets, gold and silver would benefit most. They represent real value, not debt or promises, and in the next round of currency debasement, he expects them to rise the fastest. Let's get back to the interview.
It is true that the standing repo facility that they have now has never been this high, but there's no economic difference between a standing repo facility and a repo facility that's on the fly. It's all the same thing. Dollars are dollars. It doesn't matter if you're standing there or sitting there or lying there or flying there while you're doing repos. Doesn't make a difference. Repos are repos, and they've been higher. When will this finally spill over into the rest of the markets? Well, I don't know. But I can tell you that the weakest part of the markets that have been the weakest since since Treasuries started to fall and interest rates started to seriously rise when the Fed started hiking interest rates, that is the commercial mortgage-backed securities market. Of course, lockdowns would be pretty bad for those things because when you lock down, people stop going to offices to work and they start working at home, and then that becomes a habit, and then the office real estate isn't worth much because nobody's going to it anymore. Nobody wants to renew their leases. So we have here from TREP. The TREP CMBS, commercial mortgage-backed security delinquency rate, resumed its climb in October 2025, jumping 23 basis points to 7.46%. We'll just read a few paragraphs here. In October, the overall delinquent balance rose 1.1 billion to 44.6 billion. That's about the size of the Madoff Ponzi scheme, which was 50 billion. All 5 of the major property types saw increases in their respective delinquency rates. The largest rate increase was seen in the office sector, which soared 63 basis points in October, which set a new all-time high of 11.76% after retreating by over 50 basis points the month prior. Earlier this year, the office delinquency rate hit new record highs of 11.08%. In June at 11.66% in August, both now eclipsed by October's new peak. So we see office CMBS getting worse and worse and worse. And now that culture has changed and offices are no longer in demand because of the lockdowns of 2020, the wisdom and the compassion of those lockdowns had the unintended consequences of making office buildings almost worthless because nobody goes there anymore. Anyway, one more sentence here. The second largest rate increase was in multifamily, which rose 53 basis points as delinquency rates to 7.12% and topped the 7% threshold for the first time in nearly 10 years since December 2015. So, how much longer until something in here implodes? Can't be long now. We're already at record highs in office delinquencies. Now, there are so many bubbles that still exist because of the money printing of 2020. And the one that I follow closely is actually the Bitcoin bubble. You can't even call Bitcoin really a bubble, and I'm waiting for all the comments below to tell me how I don't understand Bitcoin. Well, that's true. I don't understand Bitcoin. I have no idea what it is. And you know what? Neither does anybody else, because it's not a thing. It's just a code to an empty safe with an empty safe inside of it, and so on and so forth, until you get to the final empty safe, which has nothing in it. But anyway, this is Bitcoin in gold terms, how many ounces of gold it costs to buy 1 Bitcoin. And the high we can see is still back from October 2021. And yeah, it was briefly broken for about 2 weeks in late 2024. But that breakout was a false breakout because it could not follow through. And we see the triple top was confirmed here. And now we are at the trend line that has been in place since the end of the crypto winter in 2023. If this trend line is broken decisively, we have the final line of resistance at about the 200-week moving average at 22 ounces of gold, just below 22 ounces of gold. Once this falls, that should be the signal that all the other bubbles are popping. And the Fed is going to have to print a lot more dollars to reflate everything. Everything will be reflated, including Bitcoin, except the only difference is that the thing that's going to go the highest, the fastest, going to climb the fastest is going to be gold and silver. And everything is going to become a lot cheaper in terms of real money as the value of credit falls and falls.
Market calm often hides its own contradictions. Stocks still hover near their highs, headlines sound reassuring, and yet, beneath that surface, something quieter but more meaningful is unfolding. Precious metals are behaving differently this time, less like a speculation and more like a shift in foundation. The pullback in gold and silver isn't panic selling, it's the market taking a breath, resetting before another stride forward. Each dip has found strong hands waiting underneath, suggesting conviction rather than fear. At the same time, cracks are forming in places most people aren't watching. Commercial property debt is straining, delinquencies are climbing, and the same financial engineering that once propped up the system is now showing its limits. Central banks can repackage liquidity under new names, but the outcome doesn't change, more dollars chasing fewer real assets. It's a loop that can only stretch so far before confidence gives way to reality. And when that happens, tangible wealth tends to rise while paper wealth fades. Could this quiet rotation into hard assets be the early signal that the next phase of the financial reset has already begun? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.